picture. We're talking real money.
Oh, that's my evil laugh. Hi, I'm Don, and Tom is over there, but he can't speak right now. My evil plan worked. No, I'm kidding. He's having technical difficulties, so it's going to be me for a minute, which is fine. While he figures out, he's going to reset your internet too, Tom. Reset your whole internet-y thingy over there. We're here to talk about money, no matter who's here to do it with you. And we do it in all kinds of ways. We help you on the show. We help you on the website, talkingrealmoney.com. We have advisors who will help you. We do it. Everybody's out there to help you. We really do believe in helping you for free for nothing. And you can call us right this very moment. Right now, because I know that lines are open because they all are. 855-935-TALK is the phone number. That's 855-935-8255. If you are thinking about getting into some sort of an investment, call before. If you've already done it, well, then we'll try to figure out what's the best course of action from here. If you are trying to save for retirement, you're trying to create an income plan, you're wondering where the money's going to come from to support you, if you're trying to put a kid through college, if you're trying to buy a car, if you're in debt up to your eyeballs, whatever it might be, if it has something to do with money, okay, not just vaguely to do with money, more specifically to do with money, give me right now, a call at 855-935-TALK, 855-935-8255. So easy, so simple, and so different than everything else out there. There is nobody that I know of on the radio doing something like this, where we give you advice based on science, on academic research, on decades of experience, that isn't self-serving. Oh, there's so much self-serving stuff out there. Sure, we're in the financial business. Do we want to make a living at it? Yeah. But do we think we're the only ones who can help you? No. We'll help you find somebody else. We're like Santa Claus and Miracle on 34th Street. We're Macy's. Gimbel's is down there. Sometimes Gimbel's is better. Or whomever else. I guess Gimbel's didn't make it. And so, give us a call, 855-935-TALK, 855-935-8255, while Tom tries to get reconnected. We both, this is funny, this article came out in Bloomberg Business Week last week, and both of us almost simultaneously went, oh, what a great piece to talk about on the show. The article is entitled, What to Do with Your Money and Your Life in a Wild New World. And it is a wild new world. It's so different since the pandemic. I know you feel it. Things have changed. Even for money, it's changed. It's changed in so many ways, but in money. I mean, for example, we hadn't had any bank failures since 2008. And then we see suddenly, almost at the same time, two mid-sized banks, Silicon Valley Bank and Signature Bank, both fail simultaneously. But not only did the FDIC step in, but then the government stepped in altogether and said everybody's going to be made whole. Other banks picked it up. And this is something that we have talked about in the past, that I have definitely talked about in the past when we've had problems with banks being in trouble. The reality is, you are, no matter how much you have, likely to be made whole. You will absolutely be made whole if you have less than $250,000 per depositor. So you're in pretty good shape. As a matter of fact, some of the brokerage firms now are creating savings accounts where they're going out to multiple banks and splitting up your $1 million or $2 million into many different banks so that you get FDIC insurance across the board. But the question that was asked in this article is, with all this going on, should I be putting my cash under the mattress? And the answer is really, truly no. There are great rates out there. If you are worried at all, don't put more than $250,000 in any one institution. You're in great shape. Government bonds are paying well. Everything is paying well. Just get the short-term stuff.
Tom and Don are talking real money.
Do me a favor. Grab your latest investment statements if you know where they are. How many do you have? A lot? How many different investments are in each statement? A bunch? Do you own individual stocks, bonds, sector funds, and stuff you don't understand? Yeah, I thought so. I'm Don McDonald, and I'm pretty sure you have a case of hodgepodgeitis. But don't worry, it's not terminal and can be cured. But it takes three things: a bit of time, some fiduciary guidance, and a plan. There's a problem, though. Most financial advisors can't or won't provide any of those. That's where we come in. Tom and I will provide you the help you need to overcome hodgepodgeitis in a free, no-obligation meeting with an Appella advisor at TalkingRealMoney.com. So, scan or take a picture of all those pages you gathered, then go to TalkingRealMoney.com, click on Meet an Advisor, and set up a free appointment online or by phone when it's convenient for you. Let us sort through the mess and help you get started on a better, simpler future plan. Just go to TalkingRealMoney.com or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Hi, welcome back. I'm Don, and guess who's over there with a mic that works now?
Having been thrown out of the egg roll, I'm back. So,
he's back.
Yeah. That should scare you. Yes.
You know, he scares me. 855-935-TALK is our phone number. We'll be back to talk more about what to do with the money in your wild life, the new wildness that is our lives. But first, we interrupt this program for a caller. Jacob, welcome to Talking Real Money.
Hi, gentlemen. How's it going?
Good. What's up, Jacob?
So I have just a general question about getting some good direction guidance on kind of what to do moving forward. A little backstory about my situation. I went back to school, got a second degree, finally got my dream job. I had to hit and basically did a career reset. I went from making the low six figures and then ended up cutting my pay in half. But for the sake of my sanity, I made the move from blue collar to white collar, and for the sake of my sanity, from my the career change, and I'm working my dream job now. But you know how it is, hitting the brakes and having to start over with lower income and all that jazz.
I totally know the feeling. Jacob, you keep covering Jacob, you keep covering your mic up, and you get muted. I don't know what's going now. See, now you're muted, and before you were clear. That's really weird. Anyway, go ahead. What's the general question?
Okay, hopefully it comes through all right. I'm up in the mountains. So the general question is, to make that career change, I ended up liquidating my 401k from my old job to clear all of my outstanding debts. That way I could afford to live with a lower income. But now that I have the new job, I'm just about to hit a year in. I've got 8% contribution on that 401k. But what little bit of money I do have invested is all over the place. And I guess what I'm looking for is, if you were in my position and you wanted to have an aggressive catch-up strategy, what kind of tips do you have for someone who might be in my position who was crazy in their 20s and kind of wasted a lot of money and a lot of time, is now in their 30s going, oh my God, retirement is really not that far away.
Let me just
kind of get back and make up some ground?
Let me reiterate the question. So Jacobs has a lot of investments all over the place, you have a hodgepodge. And so what should you do to get back on track toward your retirement goals that you wisely need to get back to?
And you're saying you want to be aggressive. I mean, when you say aggressive, to me, the first part is the stock-to-bond ratio. So if you want to be aggressive, you're not going to have very much in bonds, right? 10, 20%, maybe even less. Yeah, I mean, if you're under the age of 40, I don't know that you should have a whole lot in bonds because you don't care that the portfolio is going up or down.
Zero in bonds.
Okay, which is fine.
Right now,
There you go. Okay, then here's the part that I see most people make a mistake with. They have most of their assets in U.S. large companies, most of it, and S&P 500, large cap growth, etc.
Guilty.
What you really need to do. Yeah, what you really need to do is diversify. I mean, here's an easy way to kind of do the math if you have to. You take 60% of the money and say it's going to be in the U.S., and you take 40% and say it's going to be outside the U.S., okay? Then in each one of those categories, thank you, you divide it between big and small for U.S. and international, if you can.
Let me make it easier. Because, I mean, I'm guessing you don't have, six figures yet, right?
No.
Yeah.
That's a big old no, but I am debt-free. 100%
Yeah,
debt
so
free.
here's what you do. You make it really simple. You go out and you get the Vanguard Total World Stock Index Fund, ETF,
And?
VT. And then you either get the Vanguard Small Cap Value Index ETF or the Avantis AVUV, the Avantis Small
that's
Cap
fine.
Value.
Yeah, so you do one that's a total market.
Just that.
And then you add in 20% small cap value.
Or if you want to be more aggressive, 30% small cap value.
That's true. So you're overweighting to a large extent the actual size of that asset class. So now you're really tilted to things that have been more productive over time.
But more scary over time.
Yeah, I think that's a great strategy, Don.
Yep.
And that's simple.
And it's
so now
simple.
you have exposure globally. You have some large, a lot of large in that one holding, but you've added in a large component of small value companies, which the expectation would be that they outperform. I think that's a great strategy.
And congratulations on the reset. That's
you.
a brave thing to do.
It
I know the
is.
feeling, but it's a brave thing to do.
Yeah, it's the scariest but most validating thing I've done in my life for sure.
Well, good for you. And sometimes we have to take
Well, I
a hit. You know,
appreciate
people
you
say the
Yeah.
401k and the IRA should be inviolate, that you should never touch them. But sometimes life throws
have
you
to.
things that force you to do it, and you do it. You get past it, and you start over in an even bigger, better way. And that sounds exactly like what you're doing.
Yeah.
So good job.
The tax hit was rough, but
Congratulations
it let
on
me
doing that.
pursue
That's
this
not
path,
easy.
and so I don't regret it. And thank you guys for that advice. I'm going to absolutely pursue it and take it to heart. Thank you.
And it's a breeze, too. It's just so easy to do. Good luck. Consolidate.
Easier than
Forget it.
climbing in the mountains. Easier than climbing around the mountains wherever he is, because it sounds kind of murky.
Well, it's because he keeps sticking his head in snowbanks. Still snow up there, right? 855-935-TALK is our phone number. 855-935-8255. See how easy it is? It's just so easy. Call us. Michael, you're next. Welcome to the show.
Hello, this is Michael. How are you?
Good. Thanks, Michael.
Wonderful. My question, I have over $250,000 that I've taken out of the market because I've been wary of our financial position as a country and this new emerging alliance with these BRIC nations that are trying or attempting to have a currency to supplant the U.S. Dollar as the currency of the world. So we're wondering, with all that happening, how do you feel where the market and stock market will go if that eventually takes place?
Well, I think that's a huge leap to go to. The dollar is going to be replaced by the yuan or the renminbi. It's
Yuan, yeah.
It's just. I mean, really, no one on the planet wants to use the yuan in place of the dollar because you can't trust the Chinese government to allow free markets. So the whole premise is flawed from the get-go. I don't know from what sources you get your news, but they're a little whacked. Go ahead, Tom.
Well, and I was going
what
to
about
add, let's
the
just
alliance?
assume you are the alliance.
The alliance with Brazil, China,
Brazil's
Russia.
currency is weak.
I know, but they're actually going to become half the world's population. Now they can supplant the U.S. as
What?
the world.
Excuse me, but have you ever studied history, Michael? I mean, the Brits,
Yes, I have.
the British for over a century, were much smaller than the population of the rest of the world. They hardly had anybody compared to the rest of the world, and yet their currency and their economy dominated the world until the U.S. took over. During the 20th century. So the whole premise, the argument is all flawed. I don't want to have a political argument with you, but your argument is flawed. The fact is these currencies are not trusted. Could it happen in 30, 40, 50, 60, 70, 80, 100 years? Sure, but we don't look out that far.
Tom and Don are talking real money. For your real life and real future,
Like
Tom
that
and Don
guy.
are talking real money.
Number 855-935-8255. Go ahead.
We're happy to debate anybody.
No, we're not. No, we're not. No.
Yeah, we are.
No. No.
The thing is, and we're not laughing at Michael's. He may end up being right. He might end up being right.
Well, yeah.
As you said, 30, 40, 50 years, whatever it is. But here's the question. Even if you knew that to be the case, how would you invest?
Right.
What would you do? What would you do? I mean, would you take all the money and
buy Brazilian stocks?
I don't know what you do. Yeah, I guess. I mean, and we own some Brazilian stocks, not very much.
No.
I don't. It just, again, what would you, if you knew how
Chinese
the future is going to
look? And he said the BRIC countries.
We own a little tiny bit.
Economically,
That's
Russia's in trouble.
Well, we don't own Russia anymore. Everybody got out of Russia at the beginning of the Ukraine war.
Brazil is not a very stable economy. They're certainly nowhere near ready to take the world stage as a massive power. India,
unless we're all gonna eat beef.
Come on, think about that for a minute. India has a
lot of people, but not as good.
A lot of people doesn't mean anything.
Yeah,
Asia.
I agree.
Asian countries have had a lot of people they've had more people than the European world for millennia. But that's not a good argument for the quality of an economy. One of the reasons why the U.S. dollar, let's just discuss this for a second. One of the reasons why the U.S. dollar is such a strong currency is the same reason why the British pound was such a strong currency in its day. The reason is the economic and military might of the country backing that currency. Nobody is at the point of challenging us yet. Will they be someday? I hope I'm dead by then, but it's possible.
Well, it's definitely possible. I mean, you don't have to go back that far when the United States was an emerging market. Mm-hmm. Like 150 years. I mean, we were.
But
the stock
150 years is 5 generations.
Okay, I'm just saying could it happen? Sure. But again, my take is I'm not going to argue with you on that because I don't know. But what I do know is I'm not sure what I would do differently even if I did.
Right. Let's assume it's going to happen. What are you going to change? I would have a globally diversified portfolio to make sure I had it all covered.
There.
You don't try to time the market because then you have to be right not just about what is happening, but when it happens.
And I'm going to add one more thing. One thing we do know, unequivocally, is when you move money out of the market and try to move it back in, you can call it timing, you can call it whatever you like, you end up with less money. Yep. That I can guarantee. I can guarantee it. There are hundreds of studies that have looked at this. And
no, you can't guarantee it because they could get lucky. They could get lucky twice.
But the study after study shows people who move their money around end up with less. So the idea that you would do that in anticipation of something is really a bad idea. I'll put it that way. Really is.
Mark, you're up next. Welcome to Talking Real Money.
Follow that one.
Hi,
yeah, go ahead.
A couple questions about a couple individual stocks. What your thoughts were on, and one of them is Cisco. It's kind of a dog, and the other one is Paramount. I got some Paramount preferred, some Paramount. It's got good dividend, but I'm just kind of on the fence on the Paramount whether I dump it or just wait the year and a half till it breaks even with dividends.
Okay, two things. I'll give you two answers. One, yes, I would absolutely dump the Paramount because it's a preferred stock. It has really no growth potential. All it has is the dividend. Two, I would dump the Cisco because you're owning individual stocks. Could Cisco fail? Absolutely. Heck yeah, it's a
especially
tech
in
stock.
That industry.
And tech gets usurped, gets changed. It changes so fast that these companies become obsolete and have in the past almost overnight. Owning individual stocks is pure gambling. It's super, super dangerous. Super dangerous. So I would sell them both. I would not own individual stocks. I think we both agree it's a waste of time. It's a potential waste of money. And it is really nothing more than just gambling through your broker as opposed to in a casino. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
And wow, have we had some unique calls today. We really have.
That's one way of putting it, yeah. Okay.
Oh, my goodness. They're really, I mean, wow. Usually our call is, I just got $100,000. What should I do with it?
That's number one.
These were not boring.
I want to start a new currency.
855-935-TALK is our phone number.
Well, it is a wacky world.
935-8255.
Call now.
It is a wacky world, and that's what this article from Bloomberg says. What to do with your money and your life in a wild, wacky new world. And at the top of the hour, I talked about putting your cash in a mattress as opposed to putting it in a bank, which I think is a dumb idea. Now, Tom, here's a question for you from this article. This is actually the question. Quote, what's the deal with bonds now?
Yeah, I mean, because bonds are an IOU, right? The idea here is the person issuing it is going to pay you back with some amount of interest in a period of time. So there's an aspect of more safety to it than stocks, which are just an investment in companies. So they have a reputation for kind of being safe. But last year, wow, adding to that wacky world, Don, you had the Vanguard Total Bond Market Index lost 13%. There were bond funds that lost far more than that, by the way, that are longer duration bonds. They got creamed last year.
Right, but by the way, we have never, ever suggested long-term bonds. Never.
Nope.
Because that's what happens to them.
Yep.
They get creamed like stocks and they don't recover quickly. Short intermediates, they recover.
They do recover. And so for many people, the moderate 60-40 portfolio, 60% in stocks, 40% in bonds, lost somewhere about 14% last year. It's felt bad. So, but what about this year? What's happened this year? Well, here's what happens with bond funds. Those bond funds, and I just looked up a couple, the aforementioned Vanguard Total Bond Market Index Fund is up 4.3% this year. Now, some of that is due to the fact that, prices have gone up this year, right? Because people have trusted those bonds. But here's the other part that I think you need to know about bond funds. Bond funds own a series of maturities in them. It's not all the same year. As these funds are buying new bonds, those yields are going up, right? They're higher. They're the old stuff they're getting rid of. It's being paid off. The government's paying off their debt at 1% or 1.5%. The new stuff's being issued at, well, you can go look it up, 4%. So now those bond funds have higher yields. They're returning a little bit. What do I expect? I expect in the long term, we're going to get back to a more, I hate to say this, non-wacky, more normal market, right? I mean, where you're getting 3-4% a year from bonds. I don't have any idea about stocks, but the bond part of the portfolio is there. By the way, I looked up the dimensional intermediate term bond fund as well, up 4.6% year to date. Don't know what the rest of the year look like, but I can tell you bond funds yields are going up because the yield of the bonds they are buying are higher. That we do know.
Have been going up.
Thank you.
We always have to speak past tense.
Yeah.
As a matter of fact, I'm kind of shocked that Joe over there, Ron, made a prediction. You made a prediction,
which is what?
That bonds were going to go back to normal.
I hate to use that word because what is normal? Right?
It means they don't go up, they don't go down much. But that's the thing. What short to intermediate term bonds did was actually what we expected them to do.
True.
When rates rise, the value of bonds fall. They fall. But that's why you own short to intermediate term bonds, because even though the prices of them on the secondary market fall, what we're seeing right now is those 2 and 3 year, 4 year, 5 year bonds maturing at their face value. You see, the loss is only temporary to the fund. It is only temporary. They get that money back, and then they take it, as Tom said, and they buy new bonds at the new higher rates. That's why we keep with those. We don't ever predict that you're gonna that anything's going to go up or down in any sort of a certain time frame. Which is why we suggest you diversify. That helps alleviate a lot of that anxiety.
By the way, it's not just stock diversification, it's diversification of type of securities between stocks and bonds. Exactly.
Yeah,
yes.
Absolutely. And because we can't predict, that's an inherent problem. Nobody can accurately and consistently predict what the future's going to be.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
In radio time, you have about 10 minutes. About 10 minutes to call us at 855-935-TALK if you were planning on doing it today. So give us a call, 855-935-8255. So continuing on our journey through the article, What to Do with Your Money and Your Life in a Wild New World from Bloomberg Business Week. Bloomberg Business Week. That's a lot of B's. Yes, indeed. All right, here's the one. This is the one. This is the big one. We're going for the big one now. Ladies and gentlemen, are stocks cheap? 3 words.
You want my answer?
Yes, are stocks cheap?
3 word.
Yeah.
I don't know.
Wow. Wait a minute.
Sorry.
Wait a minute. What kind of financial guy are you if you won't lie?
I hate this so much because it either does one or two things. If you are invested in stocks, you think, maybe I should sell now because if they're asking this, maybe they're not, and I need to get out of the market, right? Mm-hmm. Or if you have money, you're thinking, cash, well, I don't want to invest now. I'm going to wait till they get cheap to get in at the bottom. Mm-hmm. No, nobody knows the bottom.
But all these articles ask this question. It's all you hear on CNBC. If you sit and subject yourself to that noise all day, it's almost as annoying as The View. Just to sit there and watch those heads talk to each other. Oh, my God. The View, we got like 35 people talking simultaneously. I mean, with us, at least there's only 2.
Yeah, touche.
Talking over each other.
Back to our stocks cheap. We don't know. But here's the thing about actually, this is true of the bond part as well. You should own these securities dependent on a few factors. Number 1, what rate of return you seek. Number 2, how much volatility, ups and downs, you're willing to accept. And number 3, how soon until you need the money. Those things have nothing to do with whether stocks are cheap or bonds will rebound or whatever, or new currency is going to come into place. Don't matter. We don't know. You don't know, but you do know those 3 things, hopefully. And if you don't, you should take the risk quiz. You should have a plan that says, here's what I'm trying to do. That's it.
And if you're like most people, you invest slowly. Like you earn money. You earn a little bit of money every month, or maybe a lot bit of money every month. But along the way, you do like Tom and I do. You put some money into your 401k, and every month you're buying stock, whether it's high or low.
Good point.
So you're getting a price between the high and the low, which is a pretty good place to get in. If you can get in between the high and the low and then just ride it for decades back up to new highs, which, by the way, have always happened. Always.
And they will again, yeah.
Always. They've happened since the beginning of stock trading. Prices in general have risen. The value of economies have risen. The stock markets in the U.S. go up 3 out of every 4 years on average.
And last year was a down year. I mean, here's the other thing about this entire situation. Our intuition, our emotions do us wrong with this. When the market's at record highs, most people think, hey, I got to put money in because stocks are hot. After the market goes down, like last year, they think, well, I don't want to invest in something that went down.
No.
That's what I'm saying. So your emotions are leaving you to the wrong conclusions. You're exactly right, Don. You should have a regular systematic plan if you're investing. And then the other 3 things I mentioned earlier. Otherwise, it's conversation. It fills the pages, but it really has no impact on you directly because you are about you and your life, not about this.
And doing it the right way is so easy. You don't even have to think about this stuff. Like the next question, which is, what's all this I hear about a recession? What's this recession business I'm hearing about? Should I be worried about a recession? It might steal all my money, those sneaky little recessions. They sneak up on you and they steal your money. They grab it right out of your pocket.
Which may happen anytime anyway. Goldman Sachs now says they believe the odds of a U.S. recession in the next 12 months are 35%. I'm not sure what that means. Does that mean there's 65%?
65% chance we won't get a recession.
I guess I just...
So wait, there's a better chance we won't.
That's up, by the way, from 25%. That's a silly thing again, and there's no reason to consider investments.
And
period.
It's baked into the cake.
Exactly. Thank you.
Expectation that 35% chance is already built into the stock market. So, okay. This is fun stuff. I just really love it. John, thanks for the call. Welcome to Talking Real Money.
Yes, glad to be on the radio, and I appreciate your show and the help.
Our pleasure.
So my question is, so it's actually for my mother. She's 78 years old, and my dad just recently passed. And so he left. She has about $90,000 that he had in his 401k, and they have about $100,000 just in savings. And we're just wondering where the best place would be to put, that money to extend as long as possible.
We're into it. We're back to our normal questions. Tom?
This is money that is being spent on a regular basis, correct?
Yeah. So she's got I think it's right about $100,000 in savings. The rest is still in my dad's 401k that we haven't done anything with yet.
Yeah, I don't know enough to know. Yeah.
Yeah.
The simple thing, like the 401k, could be a target date kind of product because you're going to have substantial amount of bonds, right, due to your mother's age. The rest of it I wouldn't mess around with. I would keep it in a high-yield savings account that's making, now today, 4%.
High-yield savings, okay.
Yeah, shop around. There's some really great rates out there.
That's really, and then the money that's in the retirement plan, not to mess around with it too much, just a target date, I don't know, 2015 or 2010 or something like that, right? I mean, I wouldn't mess around with that very much.
Okay, so just kind of leave that.
Yeah. I think that's
eventually
you don't want to do anything crazy. The money is going to you're going to use it. You're using it, and you need to keep it reasonably safe. You want a little bit of a growth component, and that's where that target date fund comes in.
Yeah, gives you something. Eventually, that money, I believe, will have to come out because if it was in your father's name anyway, it needs to go into.
Come out, but then it can remain. It can remain invested after it comes out, and the taxes are paid on it. But the how they should be invested, it doesn't matter whether it's in an IRA or out of an IRA. You need to have a portion in something like a target date fund, so that you still have some exposure to the equity market. And with a 2020 or a 2015 or whatever it is target date fund, it's going to be very low.
Yeah, it's going to be more than half maybe in bonds at that point.
Sure. Yeah. So I hope that works. Thanks so much for the call, John. We really appreciate it. Sorry about your father. Glad you're taking care of your mom. Good job. And we are going to sneak away for a minute. Remember, you can call us 24/7 at 855-935-TALK, 855-935-8255, as well as going to TalkingRealMoney.com with your questions.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And if you need a little bit more time than you're going to get asking us a question on the show or asking it on the podcast, remember, and we started this a long time ago, we have an investment advice firm. People pay us to manage their money. That's part of the deal. It's what we do. Part of what we do. We do this too. But we know that not everybody needs to hire us, that there are a lot of people getting started. There are a lot of people who, well, just do it themselves and do it quite well. But often there are really complex questions that come up that require more time. Now, most advisors are going to say, hire us or hit the road, but we're going to say, we'll help you. Just set up an appointment with one of our advisors. No cost, no obligation, no high-pressure sales pitch. You just do it at talkingrealmoney.com and click Meet an Advisor.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.